Hey guys, hope you are all having a great weekend. Today's video is going to be super short and to the point. It will be a continuation of sorts to what we discussed yesterday. We are going to go over Citadel Securities' financial statement for the year 2020, and examine what Citadel claims to do in order to have a better understanding of how they perform, how they plan and execute, and get a generally better understanding of how they operate. We are going to go over the full report, which isn't very long. It is only 18 pages, half of which are procedural introductions, guides and signed affirmations. We are going to Tokyo drift through this, so don't expect a super elaborate or difficult to understand video. This is going to be super brief, and straight to the point video. I will link the document for you guys in the event you want to go over it again. This link will be located in the description of the video below. Before we start, let me make the disclosure that I am not a financial analyst or advisor, and that all contents discussed in this video are provided as opinions. All efforts are placed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Everything presented is evidence I collect, and all opinions are based on research, experience and knowledge on the matter. I want to thank all my Patreons and one-time donors, who continue to carry this channel. With that out of the way, let's dive right in. The report starts with general information, disclosing Citadel Securities as a Delaware limited liability company. They say they engage in market making and liquidity provision in U.S. options, equities, government securities and foreign exchange products, as well as trade executions. It then goes over significant accounting policies, giving some brief descriptions as to their involvement with offsetting financial instruments, derivative contracts, which we have talked a lot on this channel this past week, as well as disclosing transfers of financial assets, foreign currency translations and the valuation of financial instruments. We are going to skip all of this because nothing here is needed to understand what is going on. I just wanted to let you know of their accounting policies. We will also skip all over the financial conditions and statements they disclosed because it's boring stuff that adds nothing to what we want to know. Instead, we are going to hyperfocus on the note section. Starting with borrowings and revolving credit. I want you guys to pay attention and memorize all the names we are going to talk about, because chances are we have heard of them before. Citadel entered into a revolving credit agreement with J.P. Morgan Chase Bank as administrative agent and various external lenders for a total commitment of $500 million. The revolving credit agreement has a maturity date of December 17, 2021. Interesting stuff, considering the content we talked about on Thursday's video. Revolving credit agreements and general swaps have my alarms ringing as loud as the ice cream truck that comes around every day. The statements disclose other stuff, but nothing major that is imperative to your knowledge, so we are going to simply skip past it. Then we get to risk management, which is the spicy one that we went over yesterday. I will go over it again for the sake of whoever might have missed it. Citadel states that they are subject to various risks, including, but not limited to, market risk, off-balance sheet risk, credit risk, currency risk, and liquidity and leverage risk. While the Citadel trading managers often hedge certain portfolio risks, the trading managers are not required to do so and will not, in general, attempt to hedge all market or other risks in the portfolio, and they will hedge certain risks, if at all, only partially. This is quite interesting to me because even though this is in no way an admission of guilt to anything wrong, they are at the same time essentially stating that they will hedge all market risks in their portfolio. It shows their mindset, that they are determined to do whatever is necessary to protect their customers and assets. On their market risk section, Citadel states they sell various financial instruments which it does not yet own or which are consummated by the delivery of borrowed financial instruments. Citadel is exposed to market risk for short sales, which involve the risk of an unlimited increase in the market price of the particular investment sold short, which could result in an inability to cover the short position and unlimited loss. Are your bells ringing yet, people? Citadel then comes with a huge home run, saying there can be no assurance that securities necessary to cover a short position will be available for purchase, and that to attempt to manage this market risk, they may hold financial instruments which can be used to hedge or settle these obligations, and monitors its market exposure daily, adjusting financial instruments as deemed necessary. Also, Citadel's ability to conduct short sales on certain specified securities could be restricted due to regulatory and legislative rules, thus resulting in a reduced inventory of securities available for borrowing and increased transaction costs relating to short selling. I am not even going to explain this because it is pretty straightforward. Please pick up your jaw from the floor, because we aren't done yet and it's not even the biggest mic drop moment. On their next section, Citadel talks about the off-balance sheet risk. Get this. Citadel admits they regularly enter into investment transactions which may represent off-balance sheet risk. Off-balance sheet risk exists when the maximum potential loss on a particular investment is greater than the value of such investment, as reflected on the statement of financial condition. Off-balance sheet risk generally arises from the use of derivative financial instruments or short sales. Boom. They get into transactions that may represent off-balance risk, which arise from their use of derivate financial instruments and short selling. Can we get an applause? These cute little theories, they aren't theories any longer. They are full-fledged facts as to how these clowns operate. Then we get to credit risk, which is really sound as some of the stuff here applies with the content we discussed on Thursday's video. Credit default swaps and everything in between. I will link that video in this video's description as well because it was a pretty big drop and it didn't get nearly the attention I think is warranted. Citadel explains that credit risk is the risk of losses due to the failure of a counterparty to perform according to the terms of a contract and that they themselves do not complete all of its own securities transactions. This can, and often does, result in a concentration of credit risk with one or more institutions. A substantial portion of the Citadel's options, clearing and financing activities are shown to be transacted with a Bank of America Merrill Lynch subsidiary. Ring ring ring. Here is another player in the game. Then they go to state that all positions are recorded at fair value. What an absolute joke. Citadel says that this results in a concentration of operational and credit risks with Bank of America. They actively review and attempt to manage exposures to various financial institutions in an attempt to mitigate these risks while also minimizing this credit risk by carrying minimal excess collateral above any specific collateral requirement determined in accordance with the contractual terms between the company and the relevant financial institution. They are saying that they themselves are exposed to credit risk. They actively have it as a role for trading dealers and clients. Then they come with another mic drop moment and state that the credit risk they take are reduced by the rules or regulatory requirements, such as daily margining, applicable to the individual exchanges, clearinghouses and clearing members through which these instruments are traded and cleared. DTCC has been passing a lot of amendments lately, and now you know exactly why this is. Ready for the third mic drop moment? Citadel then admits to seeking to reduce its exposure to credit risk associated with counterparty non-performance under bilateral OTC transactions. Big huge boom right here. All those OTC derivate videos we made, and the truth has been lying right under our noses. They use OTC to mitigate and manage risks. In an effort to limit bilateral credit risk, Citadel admits to entering into bilateral OTC transactions only with major financial institutions. Laughing in Goldman Sachs, Bank of America, JP Morgan, and I think almost if not everyone that is part of MEMX. To make you even a little more depressed, Citadel states that the cash and security account balances held at various global financial institutions, which typically exceed government-sponsored insurance coverages, subject the company to a concentration of credit risk. Can I cry on your shoulders? Who will hold me while I weep at how upfront the system is rotten that this is even allowed to happen? Shedding tears is the new normal in the financial system. They then go on to talk about currency risk, which has to do with hedging positions around the American dollar. We don't really care about that and is not pertinent directly to GameStop or other meme stocks, so we are going to skip that. They go over liquidity and leverage risk, where they state they invest on a leverage basis, and talk about contingencies they have in the event that changes are made in margin requirements by clearinghouses and member capital activities. Again, this is disclosing more in precision what we have now seen by the DTCC. Given that this document came out months ago, I think Citadel was aware that changes were going to start happening by the DTCC and wanted to appease concerns of their clients by disclosing they are prepared for these types of risk and the challenges it poses to their liquidity. I don't want to go into this because we have discussed it and you know everything you need to know if you have paid attention to each of the amendments done to the rules. Given this section is simply a warning of changes that were going to happen, and now that we know what those changes are, there is not a lot of value I derived by going over this. And lastly, Citadel talks about derivates. We talked in depth about derivates on Thursday video, which I will link, so please watch that after this video because it turned out everything discussed there came out to be true. They talk about derivates and what they are, which again I explain a lot better and smoother in my video. They provided fair values for the month of December for year 2020, but we don't care about that. And then they provide some other disclosures and that is it. There you have it folk, their report broken down and summarized in here. Now we have some answers as to how they operate, what they typically engage in as far as they are allowed to disclose legally. We have some names of affiliated parties, and most importantly, we have validation to many of the things we have discussed. I feel a little bit of a dummy for overworking myself when this document existed all this time, but I am glad to be proven right at the same time. Do not click off this video. Please let me know what you think of it, and more importantly, if I was clear in breaking everything down. Did you enjoy this at all, or was this a boring video and didn't like it? Give me feedback on it and a thumbs up if you feel this was a good video so that others can get recommended this video. Please share it with other fellow investors, everyone needs to see this. Thank you to all my donators and pledge supporters on Patreon. I don't get paid much by YouTube because they hate bot channels, so you guys are literally paying my bills and efforts. There is not a lot of you, but to the few ones out there, thank you so much. I really appreciate the love and support you provide. With that said, I will see you tomorrow, so enjoy the rest of your weekend and to the moon.